Hi there, this is Alvin from Dr. Wealth. Yesterday, the consumer price index in the US was released and the number was 8.5%. And why did it cause the stock market to rally? It is because in the previous month, the inflation rate gained 9.5%. So it seems like 8.5%, the peak has already been achieved last month. And that's why a lot of the stocks rallied, especially the growth stocks, especially the high growth stocks, they're going to punish the heaviest. Was seeing a very big rally yesterday, right? Even in the index itself, we can see that NASDAQ went up 2.9%, S&P 500 went up 2%, Dow Jones went up 1.6%. So the NASDAQ tech-heavy companies are naturally the more higher growth stocks that is captured under the index, and that's why I say that the inflation rate, when it's contained, the high growth stocks will rally a lot more compared to other normal stocks. And especially S&P 500 as well as Dow Jones will have some commodity stock that's involved, and that's why they don't benefit much if the inflation rate are not high. So that is what has been going on, but this is nothing new. If you have been watching the market, the rally of the stock market in the US have already begun somewhere in mid-June, right? Let me show you some numbers. And this is the S&P 500. You can see in the middle of June, around 16 June, in this image itself, the S&P 500 has already gained 15% based on the closing price yesterday, right? So in a span of 2 months, it has already recovered 15%. It didn't lose as much, and it covers some of the loss that has happened in this year, right? So it's still down, right? The S&P 500 is still down, but it has recovered 15% from the low in June. And if you look at NASDAQ, it has rallied even more because the interest rate punished them. The interest rate hike punished these growth stocks a lot more compared to the more diversified S&P 500. So the NASDAQ has also recovered 21% since the middle of June, also around 16 June, right? I think it's the same day. Yes, 16 June. Okay, the bottom for both indices were at on the same day. Okay, and similarly, look at a lot of commodity prices have come down, right? So commodities benefit from high inflation because their prices go up. The margins for a lot of all these commodity companies also go up. So this is Brent oil, crude oil, right? It has been down 21% from early June. Okay, slightly a week earlier before the NASDAQ and S&P 500 bottom. Right, so you can see that they move in a relative similar direction as in a counter trend because inflation is good for commodities, bad for growth stocks, and now the trend has reversed. And even when we look at some of agriculture, I use wheat as a representative, it's also down 23%. In fact, the commodity prices start moving down earlier than the stock bottoming. Okay, you can see from this chart, it's from May, in the middle of May, wheat prices have already been falling. Right, and that was during the height of the conflict, probably between Russia and Ukraine, right? And then the grains were still being blocked, couldn't exit Ukraine, and now we know that some ships were allowed to pass, right? But the downtrend has already begun May, and that's the reason why I believe that the only way to really know what the market is doing or how the situation is unfolding is to watch the market rather than to wait for economic indicators. And so I'll explain a bit more later. So this is the CPI, right? The Consumer Price Index I said just now. So we are at 8.5% for July, and then it was 9.1% in June. Okay, so I think I said 9.5% at the start of the video, so it was wrong, it's 9.1%. Okay, sorry for that error. And you can see that we only know the CPI of July in August. Okay, it's about 2 months delay. Why I say 2 months is because 2 months ago the prices have already prices for S&P 500 as well as NASDAQ have already been going up, and then the commodities have been falling. So it's been happening for 2 months, but we only see the change in August. Okay, the peak we only see the change in August. That's why if you rely on a CPI index, it's going to be slow. Economic indicators are backward looking. Markets are forward looking. So the only way to really be early is to look at the markets and not the economic indicators. And this is something that, 2 months ago, about a month ago, right, I recorded a video, I said that, I'm out of the commodities, right? I sold out everything, okay, because I think that the inflation had peaked. And it's not that I knew it because I was using some technical indicators and the prices have gone below the moving average to be more specific. So it is a sell point for me, and I said, I did a video and said I sold everything. So one of the comment came in and said, oh, you know, you cannot just look at technicals, you should look at the fundamentals, the supply and demand. So I believe this person is really a fundamental person and doesn't really believe in technicals. But my view is that, I even put in a comment and say that if you really want to be forward-looking, you want to be early, actually the market tells us what is going on. Okay, by the time you wait until fundamental come out, it's always late because even the quarterly report is reporting past quarter, and you only get it in maybe 2 weeks or even a month after the quarter closes. So it is not very useful. Economic indicators as well, right? We look at CPI only when the thing has happened and then the indicators show up, right? Essentially, it's this relationship that I want to tell you over here. So what happened was that commodity prices start to go down first. Okay, and then the consumer price index is to measure the prices, which in turn will go down, but it's only after the commodity prices go down. Okay, because even at commodity prices, right, consumer price index will track that, it track and go down, like the cars, the houses, all this kind of thing, and it will take some time for the price increase to cascade down. Okay, so there will already be some delay in the price, consumer price index, and then the Fed will probably look at the consumer price index and then do their adjustment. Right, their policy adjustment. So you can see that there is a few months delay, I would say. Okay, and that's why the only way to be early is to watch the markets. Okay, and then that's where technical analysis becomes useful. Even if you don't use technical analysis to trade, you can use it to analyze the situation and better inform you, right, what kind of a positioning you want to take when it comes to managing your portfolio, even if you're a fundamental person, right? So that is the angle that comes from. And I want to drill deeper into a lot more signals and indicators in the market that you probably have known that it's all aligned, that pointing towards one message that the inflation has peaked. Okay, so one is ARK Innovation ETF. It's a representative of all the high growth stocks, all the high risk, high growth stocks, and they are very sensitive to interest rate environment because high interest rate means that their future value gets discounted a lot more to today's value. So they want low interest rate, not high interest rate. So with this Innovation ETF has gone up 41% since 13 June. Okay, slightly before the index bottom, right? It bottomed around 13 June and it has gone up 41%, right? That's a very big gain in the span of about 2 months. Okay, so that is another sign that is telling you that something is not right. These stocks are going up, but we know the inflation problem has not gone away, but how come these stocks are going up? So again, the market is telling us something that we probably better should listen to it than ignore it. And even for cryptocurrency, they move together with the high growth stocks. Okay, so whenever you see crypto, because crypto is traded 24 hours every day, right? And it will give you a very good indicator how will the growth stocks move later when the market opens in the US. Okay, so even the cryptocurrency went up in the past 2 months, right? Bitcoin bottomed about 18 June, around the same period. Okay, that week itself. And it's gone up 29% since then. And then for Ethereum, it went up even more, 112% since 19 June. Okay, so these are the telltale signs, right? And these are different asset classes. And you can see that they move in the same direction, or they move in the same way, whether high interest rate benefit them or harm them. Okay, so they are operating as a class by itself, right? Even though they are different assets. So even for bonds, okay, you can see bonds have also bottomed out around 14 June. Bonds, of course, prices will go down when interest rate goes up. They have an inverse relationship. So for it to go up means that they expect interest rate to be moderated, right? So we can see, okay, or maybe the interest rate is not as bad as what they think so, and then the market readjusts itself. So that was what happened in the last 2 months. So you can see there are many telltale signs, regardless of which asset class you were looking at. The market was telling us something. Alright? So they all rallied around mid-June, okay, the same period. So interest rate risk is no longer a big concern at this point in time. Okay? And I think that all these have been priced in, right? So if you are thinking that, oh, maybe everything is down, everything is down, the bottom is here, which you all know. I would say that there can be another risk, okay, because one risk go away doesn't mean that it's riskless now. There's another risk that's coming into play in the foreground. Now it's the background. Maybe it will come to the foreground and become the most watched problem, and that's recession, right? And there has been some talks around this topic, but of course the interest rate raise as well as the inflation threat has always been at the foreground. But now I would think that in the next few months, the recession risk might be the one that people will talk about more. Okay, because at this point in time, right, the bond yield inversion is still happening and it's deepening. Okay, so what is this, right? Remember I say watch the market, but how do you tell whether the market is pricing for recession? And the clue is in the bond yields. Bond yield is not controlled by the government or the central bank. Okay, it is decided by the market how the bond prices actually trades, right? So again, we're watching the market to tell us about the economy, to tell us about something going to happen in the future, right? So whenever there's a bond yield inversion, there would be a recession that comes after. Okay, like what happened in before 2020, right? There was an inversion, and then COVID happened. There was a very short recession, but there was a recession. And then in 2007, during the great financial crisis, there was an inversion, and then in 2008, there was a recession. So now the bond yield, the yield curve has inverted. It's inverted even deeper than what it happened in 2019 as well as in 2008, okay, 2007. Right, so I don't know, right? Would this recession be even worse than in the great financial crisis? If it is, then I think it's not going to bode well for the stock market. So I think this will be the key risk that will be replacing the inflation or interest rate risk that we have suffered for the last 6 months, all right, or since November. Okay, so probably almost a year, right? So now there is this new problem that's coming up. And we don't know how bad it will be, but we do see some signs that's creeping up into the companies as well, right? Companies, some of them, like even big companies like Walmart, have lowered their guidance, cut their profits and these things like that, right? Even Nvidia, chip makers, all these have lowered their targets for the rest of the year. So these are not good signs, right? This shows that the recession risk is increasing. And you also see hiring slowing, right? A lot of the big tech companies, whether it's Alphabet, whether it's Apple, Microsoft, Meta, they have all announced that they are going to slow down hiring. They are still hiring, but the hiring numbers will go down. Okay, it's not as aggressive as in the past. And we also see some of the younger, smaller tech companies, they are cutting staff, they are firing staff. Okay, it's not about slowing, it's about cutting. Alright, so that is the difference. Okay, so all these signs point to us that the recession risk is growing, and we have to watch the market to see how it pan out further. Right, so in summary, I think that interest rate risk has subsided. The Fed managed to manage the inflation fast enough, I would say, right? Even though there was a bit of delay, but it seems like it is subdued to a certain extent. But I don't think that inflation will go away. Okay, so I think the inflation rate will still remain high, right? But I don't think that Federal Reserve would want to increase the rate so much more, especially with two reasons, right? First reason is that the inflation rate has so-called peaked, okay, probably maintained, right? And if they further increase it, it would probably make the recession risk even bigger. Okay, then the clue that the Federal Reserve gave was that the equilibrium, the interest rate is not at a point that it will hinder the growth of the economy or at a point that it will fuel inflation. So it sounds like the Federal Reserve are done with very aggressive rate hikes. So that is good news in general for stocks. But as I said, the recession risk is still an unknown one, and that's the one that we need to watch out for going forward. Right, so remember to like this video as well as to subscribe to this channel so that you will not miss market updates like this. Right, where we talk about maybe analyze more about recession risk in the future. Okay, be sure to be early with all your indicators and not be late and reactive to the economic indicators. I hope you have learned something from this video, and I'll see you around. Goodbye.